credit increase in the US at 5 times the rate of nominal GDP. And whereas here in 29 we had a debt to GDP ratio of 186%, and now we have a debt to GDP ratio of 379%. The difference, and this is an important point, is in 29 we didn't have Social Security, we didn't have Medicare and Medicaid, and now we have them, and the unfunded liabilities. These are liabilities that are coming due, which have not been funded. So if you added these unfunded liabilities, would be up there in the 5th floor of this building, debt to GDP. But you, as an investor, you have to think, what are the implications of this? Obviously, in my opinion, the US will continue to pursue expansionary monetary policies. They'll have to monetize debt continuously, and that will have a negative impact, obviously, on the value of the US dollar, very clearly. But the value of the US dollar may depreciate, and the other currencies may also depreciate at an even faster rate. That depends. But it will depreciate against something. I'd like to also explain very briefly why I don't think that this deflation, debt deflation theory will happen right now. You see the super bears, the deflation is that everything will collapse, and therefore you should be in 30-year US government bonds at the yield of 3%, and in 10 years at notes at the yield of less than 2%. And that the Dow Jones will collapse to less than 1,000. But I don't think this will happen for the simple reason that the Federal Reserve and the Treasury in the US, and by the way also other central banks around the world, that never paid any attention to excessive credit growth, they started to pay attention to credit growth when on the private sector it collapsed. You can see here, we have an acceleration of credit growth until 2007. And then in 2008, the private sector contracts, they save more, banks tighten lending standards, and credit growth turns negative for a while. In other words, there was a contraction here. Now, the Fed and the Treasury that never paid any attention to this excessive growth in credit, they panicked because they realized the US economy is a credit-addicted economy. You don't give credit, the economy collapses. So the government comes in through fiscal deficits and through monetization and offsets the private credit growth contraction through government credit expansion. Just like to mention one point, of course, the government's credit expansion is less productive than, say, if the private sector expands credit. But basically what you have is now here a system that creates incredible volatility. And many observers and fund managers, they didn't understand that after the credit crisis of 2008, when private credit contraction exceeded the government's credit creation and asset prices collapsed, starting 2009, the world credit expansion from government side exceeded the private credit contraction, and asset prices went ballistic up to this very date. So that creates increased volatility. And an additional word about the US government debt. We took 200 years to reach $1 trillion in 1980. By 2000, we were at slightly over $5 trillion. We're now at essentially $16 trillion, but that doesn't include the unfunded liabilities as I just mentioned. So my view would be the government debt in the US that has trebled in the last 10 years will again double or treble in the next 10 years. And that will become very, very burdensome on the system. The problem being that spending is very difficult to cut in the US. Half the households in the US, they have one person that receives some kind of a contribution from the government or subsidies. And over 49% of individuals don't pay any federal income tax. That means these people that have the ability to pay, the rich people, the 1%, if you took every single way of their income annually, it wouldn't make much of a difference on the fiscal deficit. So this will continue at a very high level. In my opinion, the fiscal deficits in the US will remain above $1 trillion, more likely above $1.5 trillion for the foreseeable future. The problem is these mandatory expenditures. This is what has to be paid for Social Security and for Medicare and Medicaid, and it's already at 75% of the budget. Eventually it will be all the budget. Where will the income come for other expenditures of the government? Earlier I mentioned that money printing has a socially undesirable impact because of the following. Take for instance a country like India or Vietnam or parts here of the Middle East where per capita incomes are very low, say $2,000 a year or $1,000 a year. So these people essentially, they will spend roughly 50% of their income on food and energy. If you're a partner at Goldman Sachs and you earn $10 million, it's not likely that you will spend 50% on food and energy, unless you have a very high consumption of cocaine. But you understand, the richer you are, the smaller the portion you spend on food. And the poorer you are, the larger the portion of your income you spend on food. And so in an environment of rising energy and food prices, the lower income groups, they suffered. Their wages, particularly in the Western world, went up less. Then the cost of living increases, and so the real wages, the real incomes have been going down. And who benefits the most if you drop the dollar bills onto a system? These are the people that have assets, the well-to-do people, because they have the assets, so the assets appreciate irregularly, but they appreciate. Whereas the people who have no assets, obviously they lag behind. So you have wealth inequity increasing, as you can see here, and that usually leads to redistributions through taxation, or revolutions, or you have geopolitical problems. So this is one of the problems of essentially printing money. Now I have to explain another point that is very important to understand. The US, by creating bubbles, they allowed essentially households to consume more temporary than would have otherwise been the case. In particular with the housing bubble, households were allowed to take money out of their homes by refinancing the mortgages and so forth, and then they went and spent that money. So as a percent of the economy, consumption went up, and capital spending turned negative, net. In other words, the depreciation were higher than the net new capital investment. So the US consumes, has a housing boom, consumes more, leads to overconsumption, is not accompanied by capital spending increases and industrial production increases to speak of. And so that leads to a huge trade and current account deficit, rising from $150 billion here in 1996 to over $800 billion in 2006, 2007. And obviously, if you have a trade deficit, someone has to have a trade surplus. And to make things simple, say, China had a trade surplus. So the US consumes, and China produces. So you drop the dollar bills into the US, allows the US to consume, but where the stimulus goes is into the industrial production of China to supply the US with the goods that create this deficit. And so industrial production goes up in China, employment goes up in China, wages go up in China, capital spending goes up in China, domestic consumption increases, infrastructure expenditures increase, and all that drives the demand for commodities. And so after this period, 1980 to 1998, during which commodity prices went down, the raw material producers of the world, they have a bonanza. Prices go up, they produce more, and so essentially the American monetary policies didn't stimulate economic activity in the US, but they stimulated economic activity overseas. And so for the first time in the history of capitalism, you have a new world. the center of economic activity shifted essentially from the old world, Europe and the US, to mostly emerging economies. You can see here, as a raw economic indicator, for the first time, you have oil consumption in the rest of the world larger than in Japan, the US and Europe. And you have also a change in the trading patterns, in the sense globalization was designed for the Americans to basically dump their surplus products onto the world. They succeeded with some products like McDonald's and Coca-Cola and so forth. But you have to understand, the Chinese had an increased demand for commodities. So they buy more oil from the Middle East, they buy more iron ore and copper from Australia and from Brazil and so forth and so on. But the Chinese were very smart. They started to also sell their products to these countries. So if you look at, say, the period here, 1995 to today, the G7 countries, as a percent of global trade, their share has been going down, whereas the share of emerging markets as a percent of global trade has been going up. So you really have a huge shift in the balance of economic power from the West to essentially the emerging world, and that creates obviously huge economic tensions, changes in the economy, and also geopolitical tensions. The way to play it in the last 10 years, this increase in the demand for raw materials from China, has been essentially to own industrial commodities. You can see the share of China of aluminum, copper, zinc, nickel, this has never happened before in history, in economic history, has gone from 10% of world's consumption here 10 years ago to now between 30 and 40% in 10 years' time. It's a huge change. And so industrial commodity prices went up a lot. In the case of copper, we never had a 10 years period during which copper prices increased this much. But the problem is, of course, that today in China, they have already in many commodities, say, between 40% for copper and for cement, 53% of world's consumption. So you have to ask yourself, yeah, in the last 10 years it was right to own industrial commodities, but what about the future? Because when you are in the early stages of economic development, obviously it's a goods economy, so the demand for commodities goes up very substantially. But as you turn into a more service-oriented economy, the demand flattens out. Here you have South Korean oil demand, 1986 to 93, goes up strongly, goes flat. I don't think that we are there in China in the case of oil, but I think we're there in China in the case of some other commodities. And concerning China, I would like you to really consider the following. If the US economy grows or contracts by 2%, is meaningless for the price of industrial commodities. Because the US is 70% consumption, the economy. And of the 70% consumption, 70% are services. Services hardly require any commodities. In the case of China, it's a goods economy, the same for Vietnam, same for India. And in the case of China, we had normalized growth 2000 to 2007, but after 2007, the Chinese had, as a percent of the economy, an even larger fiscal deficit, and they printed money. After all, the Chinese invented money, paper. And so you had a huge credit expansion here that led to symptoms of inflation, particularly in the property market, and excesses in the property market. And so, as far as I'm concerned, we had a bubble in China that is now being deflated, and people say, well, it's going to be a soft landing. Look, I've known all my life economists. I've very seldom seen an economist say, we will have a crash. They all say, oh, it will be a soft landing. Even before the worst financial crisis at the Treasury, and Mr. Bernanke said, oh, the crisis in the housing market is well contained. It won't have an influence on the economy. Well, I think the Chinese economy could crash